Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome to the Through the Noise podcast. Over the past weeks, we see global markets entering a more volatile phase as economic data, policy shift, and geopolitical events reshape investors' sentiment. Today, I'm joined by Rajat Bhattacharya, our senior investment strategist, where we'll unpack the key drivers behind these moves and what they mean for investors' positioning. Hi, Rajat. So basically, we see market volatility has started to rise lately. Do you think that we're reaching a turning point in markets, and how should investors position themselves?
Hi, Michelle. Great to be here. So, yes, equity and FX market volatility has indeed risen in recent weeks. Now, it seems like global markets have reached a critical juncture as a robust Goldilocks rally in equities since last April takes a pause. The positive momentum, I should say, was supported by strong US corporate earnings, especially from the tech sector, and a softer dollar, which has underpinned global risk assets. However, as the impact of AI grows, it's getting clearer the gap between the winners and laggards is widening. Now, the environment requires investors to be more selective. We believe US semiconductors and internet segments and outside the US in China and India offer attractive growth prospects. Indian equities in particular look compelling after the latest trade deals. However, I must add that we remain alert to risks from rising bond yields and geopolitical events, including the Japanese elections coming up over this weekend. Alternative assets and gold can help buffer portfolio volatility in this environment.
Got it. So after equity and FX volatility, will the bond markets be up next?
Yeah, it looks like the bond markets are at an inflection point. Now, long term bond yields have risen in recent months, steepening yield curves due to better economic data, concerns over the Fed's independence, and rising global fiscal spending, especially in Japan. Now, President Trump's nomination of Kevin Warsh as the new Fed chair starting from May is unlikely to ease those concerns. Warsh, who is likely to win Senate approval before taking charge, believes US rates should be much, much lower as an AI driven productivity boom curbs inflation after temporary effects of Trump's tariffs fade.
So under the current volatility market, what are the next drivers?
So, as I'm alerted earlier, there are a couple of things that we need to watch out for. One is a set of core U.S. economic data, which are likely to test markets. The coming week is set to see some of the delayed release of the U.S. jobs report and the inflation report for January, along with the outcome of Japan's snap general election. Now, US manufacturing sector business confidence jumped in January, led by new orders, which has historically been a leading indicator for an upturn in the broader economy. However, job openings have fallen to their lowest since the pandemic lows of 2020, indicating a jobless recovery could be taking hold in the US. Should forthcoming job and inflation reports disappoint, Warsh's policy easing plan could actually gain traction. Meanwhile, Japan's election is likely to trigger bond market volatility. Polls suggest Prime Minister Takaichi's Liberal Democratic Party led coalition is on course for a decisive win on 8th February, the election on 8th February. Now, such a result should allow Takaichi to boost fiscal spending, likely pushing up long term Japanese and global bond yields. Now, the yen also faces the prospect of further weakening in this scenario, which could prompt intervention from Japanese authorities if it retests previous 4 decade lows of around 162 against the dollar reached back in July 2024. Given these above mentioned risks, diversification into alternative assets that are less correlated with traditional asset classes are looking increasingly attractive.
Got it. So apart from the major events taking place on a global spectrum, let's take a look onto equities. So what about the latest US earnings season? Would they provide any strong support for risk assets?
Indeed, the US earnings remains the bedrock, I should say, of the equity market rally, with the US tech sector leading the way. In Q4 2025, the sector delivered 31% year on year earnings growth. Now we raise our AI driven US capital expenditure growth estimates for 2026 to 45% from 40%. And this is important. I repeat, we are raising the growth estimates for AI capex this year to 45% from 40% and continue to prefer the high growth semiconductor and internet segments while still remaining cautious on the software segment after the recent sell off. The semiconductor and internet segments are seeing rising AI capex, which is a positive thing. We believe the market has unduly punished semiconductors over the last few days due to the potential disruption risk, when in reality, semis benefit from ongoing disruption given AI apps require massive chip power to process the tokens they generate. Meanwhile, concerns over AI led disruption have led to significant underperformance of the software segment. This presents, I think, value opportunities in high quality software stocks.
Got it. So apart from equities, another top investor's concern is on precious metals. Over the last week, we see gold and silver having a sharp reversals. Do you think the rally is over by now?
Actually, gold and silver have indeed sharply corrected from extremely overbought levels, and we expected this. We had highlighted this in our last weekly market view that the correction could be imminent. Now, gold has found strong support at its 50-day moving average of around 4,400 per ounce, while silver tested its 100-day moving average support near $64 an ounce. Now, we believe gold's reversal offers medium term investors a chance to average in. Geopolitical and fiscal policy risks and Fed independence concerns, which have been dragging gold rally so far, are unlikely to fade soon. We keep a 6% allocation to gold in our balanced portfolio and actually favor it over silver for its defensive quality. Meanwhile, we maintain our 12-month target price for gold unchanged at around 5,350 per ounce. Now, looking back, our overweight call on gold since September 2025 has proven timely, with the metal rallying almost 40% over that period. Investors with exposure below our preferred 5 to 7% allocation should use renewed pullbacks to add exposure, with the 4,500 to 4,800 range as a reference point for re-entry.
So apart from gold, are there any other opportunities in the markets today?
Yes, I should say Indian assets received a boost following President Trump's decision earlier this week to cut US tariffs on Indian goods to as low as 18% from 50%. Now, this policy change, coming on the heels of a landmark US European Union free trade agreement the previous week, has soothed a long standing geopolitical friction. Now, the resulting optimism has driven Indian stocks to gap higher and INR, the Indian rupee that is, to strengthen, with foreign investors likely to return, drawn by India's double digit earnings growth, better valuations, and a weaker currency over the past year. India, along with China, I should say, remains a preferred market within Asia ex Japan. In currency markets, there is an opportunity to turn bearish on the sterling, especially versus the euro. The Bank of England just held rates at 3.75% this week. However, the cooling UK job market raises the odds of rate cuts in the coming months. The sterling versus the dollar is likely to break below its 50-day moving average of around 1.3475, paving the way for a test of the previous low of 1.333. Meanwhile, the European Central Bank held rates steady at 2%, as expected, with inflation remaining close to target and growth tracking near potential. Markets are pricing steady rates throughout 2026, reflecting confidence that domestic conditions remain sufficiently resilient to offset external headwinds. Given all of this, we see an opportunity to express this divergence that I talked about between the euro area and UK policy outlook through a bullish euro versus sterling idea with a target of 0.8990.
Got it. So that's the wrap for today's session. Thank you very much, Rajat, for the valuable insights. Overall, we're positive on US tech earnings. We see value in gold and is bullish on euro sterling. So if you like for the episode today, please stay tuned and don't forget to like and subscribe. We'll be back next week with more market perspectives.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.